presentation, Introduction to 401k Plans for Plan Sponsors. Today's panelists are Charlene DeMartini and Christine Hall. Before we get started, I'd like to go over a few housekeeping items. At the top of your webinar screen, you'll see a question mark icon. This is where you can submit any questions for our panelists throughout the presentation. We'll answer questions at the end if time allows, as we have a lot of information to get through today. If your question doesn't get answered, please email us at webinars@nova401k.com and we'll make sure you receive a response. Right next to the questions tab, you'll see a paper icon. This is our handout section where you can download today's material in PDF form. If you're unable to open it or download the file, just send us an email and we'll provide the PDF directly. If you're here for CE credit, please stay until the end and make sure to complete the pop-up survey. This allows us to verify participation. Certificates will be sent within a week to those who meet the requirements and complete the survey. If you'd like to view any past webinars or access the recording of today's session, you can follow us on our YouTube channel, Nova 401k Associates, or visit us at our website at nova401k.com/webinars. Thank you for joining us, and now I'd like to introduce today's presenters, Senior Defined Contribution Account Manager Christine Hall and our Mergers and Acquisitions Account Manager Charlene. To start us off, Christine.
Well, thank you so much for joining us, everyone. As we go through our introduction to 401k plans for plan sponsors, Charlene and I are looking forward to spending the next 90 minutes with you. We do have a lot of information to go over. There's a lot of information to learn about 401k plans. We will keep it at somewhat of a high level. But I know a lot of you who are attending today probably have a brand new 401k plan. So I want to congratulate you on that. That's an exciting new benefit that you're offering your employees, and hopefully it will be well appreciated. So as we get into this introduction for 401k plan for plan sponsors, I want to just go over our disclaimer. The information in this presentation is general in nature and is not intended to be a substitute for legal or tax advice. Please consult a qualified professional such as an attorney or accountant if you need legal or tax advice. All right, our agenda today is we're going to be talking about the roles and responsibilities in administrating a 401k plan. We're going to go over Nova's cybersecurity measures, 401k basics, the moving pieces in a 401k plan, distribution basics, loan basics, and then finally we will end it out with our annual calendar so that you know what to expect in a year. All right, starting off on the 401k plan roles and responsibilities. I'm going to start right here in this corner with the plan sponsor. The plan sponsor is you. And so as plan sponsor, your overall fiduciary responsibilities for the plan. Your role is to communicate the plan to your employees, to deposit employee contributions that are made for the plan, and to provide the third-party administrator, which is often referred to as a TPA, the annual information that they need to prepare information for your plan. Right over here, we have the financial advisor, and that is the individual who will assist you with choosing funds that will be made available for your plan. They're going to help you with the selection of where your funds are going to be invested. They're going to monitor things for you. They will help with employee education and enrollment meetings, and they will help you to make sure that your plan is 404C compliant. And that means that your fund menu offers a well-diversified option of funds for your employees to invest in. Then we'll go down here to the investment provider, and investment provider is where your plan's assets are invested. And that is sometimes referred to as the custodian or the record keeper, and they hold the plan assets. when your money is invested in a 401k plan and you have daily record keeping, the value of those investments are going to be done daily, and your employees will be able to go on to the investment provider's website and see how their money is invested, see when those contributions come in. That's really the face of the plan for your employees, because that's where they will do most of the actions that's required from them. The investment provider will also provide at least quarterly statements to the participants to meet that requirement, and participants will work with the investment provider for distribution request. Then finally, we have over here the TPA, or like I said, that is abbreviated for third-party administrator, and that is what NOVA provides for your plan. And the services that we provide is to prepare and maintain your plan document. And we're going to go into that in this presentation. All of these items will complete the annual testing for your plan, prepare annual filings such as the Form 5500, and provide you ongoing consulting for your plan. You know, once your plan's set up with NOVA, you're going to be assigned an account manager. And anytime you have any questions about your plan, you want to reach out to that account manager. If you want to make any changes to your plan or see how something might work with your plan, that's the person you want to go to first, your NOVA account manager. Okay, so before we dive into the specific 401k information, I do want to go over the cybersecurity measures that NOVA takes, because as we're doing the presentation, you're going to find that NOVA does request a lot of information that is confidential information that you certainly don't want someone else getting their hands on. You know, 401k plans do hold a large amount of money, and you know, unfortunately, the bad guys have noticed that, and just like anything else, if they can get into it, they certainly will. So these are things that, you know, NOVA does to prevent things like that from happening. And the first thing we want to remind you as the plan sponsor is to never send anything through email without encryption. You know, the census information that we request, you don't ever want to send that without encryption, you know, or through a secure site. Deferral files to the investment provider, payroll files, address files, never ever send those. You know, also, we're never going to send the non-discrimination testing that we prepare for your plan through regular email. You know, the ADP ACP test, the top heavy test, the 410B test, 414S testing, we're always going to send that to you securely because it contains that sensitive information about your participants in your plan. You know, most software will mask social security numbers, but some don't. So just avoid regular email. Likewise, when you have distribution request, and if one of your participants gives you a paper form, you don't want to send that through regular email either, because those forms have social security numbers on, dates of birth, addresses, everything a criminal would need to have identity theft take place. Likewise, tax forms, including W-2s, K-1s, and Schedule Cs, please send all of those securely. NOVA does have a secure file exchange on our plan sponsor link. Our plan sponsor link is what we use to collect information for your plan and also to give you the information that we've prepared for your plan. If you're ever wondering, well, how do I get on to plan sponsor link? If you look at the bottom of your account manager's emails, there should always be a link on the bottom of their email in there below their signature line that has a link to plan sponsor link. NOVA also uses software encryption on emails, and when we need to add a new contact for your plan, that person needs to be authorized by an existing contact. So a new HR person can't come in and say, hey, Christine, I'm the new person here at ABC Company. Can you add me on for the plan? Nope, I need to first get approval from someone that's already been approved on the plan, because we just want to make sure that everyone that has this access is someone that should be having the access. At Nova, we do have mandatory training for all of our associates each quarter, and we do have a password policy in place to make sure that passwords are updated frequently and are strong. So after that, I want to get into the 401k basics. And what 401k plans do is they give employees an opportunity to save for retirement on a tax-deferred basis. It's a really easy option for employees. It's made to make things easy for them to save. They can choose what deferral percentage they'd like to contribute to the plan. Most plans also have easy investment options for them, and then they can participate in the plan. Studies have found that this payroll deduction is really the best way to save for retirement because the money never gets into the individual's hands. It goes straight into their retirement account for them. And so their savings build up in that way. It's a great form of self-discipline. And for most participants, their 401k plan is their biggest asset outside of their home. So 401k plan is a really powerful, important benefit to employees. It is the primary retirement for most people, and like I said, a valuable benefit. As easy as 401k plans are for participants to get involved into, they are not necessarily easy for plan sponsors. And so that's why so many individuals are involved with helping to make sure their 401k plan is functioning according to the laws. 401k plans are highly regulated by the IRS and the DOL, and oftentimes common sense doesn't apply to 401k plans, and we'll go into that in a little bit. The rules frequently change. You know, there's always new regulations that are put out and changes that we need to put in place. And we'll even talk about some of those new things coming up for 26 in this presentation. And in most cases, you have to have a written plan document because that is going to control what your plan does. That's a very important piece. So Nova's going to help you to make sure that that plan document is in place as well. So how the IRS affects 401k plans. It requires that the plans are in compliance with the federal statute and the IRS regulations. And the IRS has developed a number of non-discrimination testings that need to be done each year to make sure that the plan is not unfairly benefiting a certain small group of employees, but that it is beneficial to the entire employee group. The IRS gives out information on what are taxable events from 401k plans, and they also provide the annual deduction limits for and contribution limits for the plan. The plan documents need to be amended timely, and they also want to make sure that plan sponsors are following the terms of their written plan document. That written plan document is really important to the IRS. They never want to hear, well, that's not how we run it. They always look to that plan document first. Now, the Department of Labor looks at 401k plans a little bit differently than the IRS. You know, being the Department of Labor, they are really looking out for the participants in the plan, for those employees, to make sure that the plan's treating them correctly. And so they look at things like making sure that 401k contributions and loan repayments are deposited on a timely basis, that the fund lineup that is being offered in that menu for employees to choose from for their investment is prudent, that expenses that are being paid from the plan are reasonable, and they also require that the annual Form 5500 is submitted to them. So I brought up that plan document a lot because it is so important. And really, that's where we look to find out everything about your plan. You know, when one of my clients calls me and asks me a question about their plan, I'm always pulling up the adoption agreement first so that I make sure that I'm giving them the correct answers. And in that adoption agreement, it addresses items like the eligibility rules for your plan, the entry dates, the compensation that the plan recognizes as eligible plan compensation. It explains how employer contributions are calculated, and it also has the vesting for your plan. So anytime that you might want to change something with your plan, you certainly do want to let your account manager at Nova know so that that plan document can be updated appropriately. Plan documents do need to be amended from time to time when the IRS gives out new legislation or regulations. They do want that to be updated in the plan documents. And typically we see plan document restatement requirements happening about every 6 years. The IRS is looking for all plans to be updated. But if you do decide to amend your plan, that would also need to be done for any changes that you need to be made. Amendments do need to be executed timely, and there are penalties if you don't amend your plan in a timely basis. All right, so I do want to give an example here. I did say that sometimes that what is in the 401k plan, like the rules for 401k plans, may not be logical. And here's an example of that. Here is a plan sponsor who wants to exclude hourly employees from his 401k plan. Well, that certainly makes sense to do. You know, it's easy to define who hourly employees are. You know, that seems like something that might make sense to do. Well, first of all, before you can even do that, that is definitely something that needs to be written in your plan document. So that can't just be a decision that's made without being in your plan document. It has to be included in your plan document. Then once it is included in your plan document, there is going to be additional IRS coverage testing that needs to be done. And so if that passes, then yes, you know, that can be done. So that is something, you know, a change like that, definitely something that you want to bring to your plan, to your account manager's attention at Nova. The other thing that I had mentioned is that the Department of Labor really looks to having timely deposits of employee contribution and loan repayments made to the plan. And that is addressed in the small plans safe harbor time frame way back on January 14th, 2010, that the Department of Labor issued. And this was specifically for small plans, which means that there are fewer than 100 participants with account balances. And the guidance that was given there is that contributions need to be deposited into the plan's account within 7 business days after the pay date from which they were withheld. They really want to see it going in as soon as administratively possible, but that 7 business days is the maximum amount as that they see as reasonable. So you want to make sure that you are having your contributions being deposited into the plan's account as part of your payroll processes, because that process is really what the Department of Labor is looking for. Now, for large plans, and those are plans with 100 or more participants with account balances, we weren't given as specific guidance as we were for those small plans. And the guidance that was given is that it needs to be deposited the earlier of, as soon as administratively possible, or the 15th business day following the month from which it was withheld. That being said, that second bullet, that 15th business day from the month in which it's withheld, does come up every now and then. You know, I'll have someone question like, well, don't I have till then? Yes, that's what is still written, but it is a very old rule, and I have not seen any plans that have been audited be able to pass with that. You know, they really want it to be as soon as administratively possible. I guess they figure now in 2025 that with all of our electronic capabilities and things, that as soon as administratively possible is way before the 15th business day following the month. You know, typically they're looking at like maybe 3 to 5 business days, but again, they want to see a pattern, that it is part of your payroll process, that, all right, I'm processing payroll, you know, once I get through payroll, this is what I do with the employees' contributions. It's a huge issue for Department of Labor audits. And if you have a large plan, this is also something that's going to be looked at with your CPA audit. So you really just making those contribution deposits part of your payroll process. Now, the Form 5500 that's submitted to the Department of Labor, that's an annual report for the plan. And it does not have any individual participant information on it. It is big picture of the plan. It's not a tax form because 401k plans are tax deferred, but it's similar to that in that it needs to be done on an annual basis. It is required to be electronically filed with the Department of Labor, and depending on what participant accounts you have would determine if it's a large plan or a small plan filer with the Form 5500. The Form 5500 requires you to put the amount of your fidelity bond on it. So you want to make sure that you have a fidelity bond for your plan, because that is something that's requested there. And that does provide coverage for you as being the fiduciary of the plan. Certain plans, like I said, if you're a large plan filer, you're going to be required to attach an audit report to your Form 5500. And generally, a large plan is any plan that has 100 or more participants with balances. There is a transition rule. If you filed the prior year as a small filer because you had under 100 participants and you get into the range of between 100 and 120, until you reach that 120 mark, you can still be considered a small filer. But once you reach that 120, you're a large filer with the transition rules. Next, I want to talk about payroll integration. And payroll integration is a relationship that's set up between your payroll provider and that the record keeper, the investment company that holds your plan's assets. And it allows your payroll provider to submit full census each pay period to the record keeper. And that will include addresses, dates of birth, dates of hire, dates of termination, compensation, and deferral data. And it includes all employees, regardless of whether or not they're contributing to the plan, because that will allow the record keeper to calculate things correctly for your plan and help them to do their roles as much as possible to prevent some work on your part. So why should you use payroll integration? Well, it can help with collecting your annual census data, because if you're providing it to the record keeper all throughout the year, you might be able to just pull that information straight from the record keeper. If your plan has former employees that have small account balances under $7,000, it will allow them to more easily force out a distribution to them, because they're getting updated census and they know when someone's employment ends, and they can send them a notice. And usually after that notice, the individual will have 30 to 45 days, and if they don't respond, they'll move that money out of the plan into an IRA for them. And that's a good thing, because it keeps your participant counts lower, in particular if you're close to that audit requirement. Having full census data can also allow the vendor to track enrollment for your plan. So once a new employee's data is received, the vendor will be able to send enrollment packets to the participant. And it also helps with keeping track of employees, because you're delivering address changes and dates of rehire. There are usually two types of payroll integration, so you'll need to check with your vendor on your payroll provider and your record keeper to see what they can do to work together. The first one is Payroll 360, and that's when the census data flows both ways. Both the payroll provider is giving information to the record keeper, and the record keeper is giving back information to the payroll provider. So the payroll provider is going to give the record keeper the census that happened for that payroll period, and then the record keeper is going to give the payroll provider any deferral changes that took place or new loan requests that might have happened, so that they have that loan repayment amount to also withhold from employees' pay. The other option is Payroll 180, and that's when the census only flows one way. So that is, in that setup, your payroll provider will provide census information to the record keeper each payroll period, but any changes that happen on the record keeper's website, the record keeper is going to notify you as plan sponsor about, and then you'll need to update your payroll records for that. So that option, that 180, is a little bit more hands-on. I want to talk about some common plan sponsor and payroll errors, just to make you aware of them. So maybe might help you to prevent getting caught into them. First off, excluding bonuses from deferral elections. You never want to exclude a bonus from your 401k contributions unless it is specifically written in your plan document that bonuses are not considered plan eligible compensation. But if they are plan eligible compensation, whatever deferral rate that the employees have in place when the bonus is paid, you want to make sure that you withhold that from the bonus as well. That is very important, because that's plan eligible compensation. If you also have a match, those deferrals that were withheld from the bonus will also need to be matched. Excluding part-time employees from the plan. Again, you never want to just exclude any employee from the plan for any reason. I had given you that hourly example before, but no, you never want to exclude any employees from the plan unless it is written in your plan document specifically to do so. Matching catch-up contributions separately from non-catch-up contributions, and also matching Roth contributions separately from pre-tax contributions. If you do that, you're going to end up giving individuals that make both multiple types of contributions more match than they should. So when you calculate the match, you want to add up the employee's total deferral amounts, which would include pre-tax, Roth, and catch-up. Add all three of those together and then calculate your match. Don't calculate the match separately on each category. Not distributing the summary plan description. Charlene's going to be talking about notices that need to be distributed, and the summary plan description is a big one. That is important. That has all the information about your plan that participants need to receive in language that should be easy for participants to understand. So that needs to be distributed. Not allowing new employees to participate in the plan pursuant to the plan's rules, and not capping match contributions based on annual compensation cap. And I'm going to go over those last two bullets in a little bit more detail here. So here's an example of not allowing a participant to enroll on time. So in this example, ABC Company has no age or service requirement. So in a plan set up like that, it's called immediate eligibility. And so that means from the date the employee is hired, they're allowed to contribute to the plan. But ABC Company does not offer Steve enrollment into their 401k plan for 6 months. So because this happened and this plan happened to have immediate eligibility, there were 6 months that Steve missed out on making contributions to the plan. So ABC Company will have to make Steve whole by making an employer contribution for the missed deferrals and also the missed match that he would have received. Okay, so in this example is going to go into not properly capping matching contributions. And we see this when there are higher paid individuals in a plan who are trying to max out on their contributions. If a plan's matching formula in 2025 is 50% on the first 6% of compensation that employee chooses to contribute, then the maximum matching amount any one participant can receive is $10,500. So how did I get that? Well, the compensation limit for 2025 is $350,000. So even if an individual earns more than that in W-2 compensation, their compensation for plan purposes is going to be limited to $350,000. So we take that cap and we multiply that by the 50% match and then up to 6% of compensation, and that's how we get the $10,500. Now, that compensation limit is an annual limit, and it often does change. In fact, it has been increased to $360,000 for 2026. So you do want to be aware of that each year of where your match limit is for higher paid individuals. And if you're not sure, make sure you reach out to your NOVA account manager. Okay. So I talked about immediate eligibility on that last slide. There are many different ways that you can have eligibility rules for your plan. But the maximum waiting period any plan can have, any 401k plan can have, is 1 year and age 21 with a minimum of 2 entry dates, which would be semi-annual entry dates. And you can also require up to a certain number of hours in order to accrue 1 year of service. And those hour amount may not be more than 1,000 hours. So again, you can't just say part-time people aren't allowed, because people who work more than 1,000 hours might still be part-time, but for plan purposes, once they reach that 1,000, they are allowed into the plan because they've achieved that 1 year of service. The age requirement of 21 cannot be exceeded. And of course, anything shorter than those requirements is allowed up to immediate eligibility. The computation period is typically the 12-month anniversary from the date of hire, and then it changes to the plan year after that first anniversary. And I'll show you an example of how this would work. For an employee that was hired on April 1st of 2025, their first initial computation period is going to be from April 1st, 2025 through April 1st of 2026. If that individual worked at least 1,000 hours during that year, then for this plan that uses the statutory maximum amount of having age 21, 1 year of service, 2 entry dates, and this is a calendar year plan. So the 2 entry dates are January 1st and July 1st. That individual would enter the plan on July 1st, 2026. Sorry about that. 2026. Okay. So if that individual did not work 1,000 hours during that first year of employment, the next computation period that we're going to look at is based on the calendar year. And going forward, we're always going to look at the calendar year. So we're going to look at January 1st, 2026 through December 31st, 2026. Did the individual work at least 1,000 hours? If the answer is yes, then that individual will enter the plan on January 1st, 2027. So dealing with rehires can be a little bit different because it doesn't go into that nice chart that I showed. So there are rules for rehires. In general, if a formerly eligible employee ever had a single vested dollar in the plan, then that person will never lose their prior service. So no matter how long it is that they are not employed with the employer, when they come back, if they had vested money in the plan, they're going to be immediately back in the plan. They won't have any wait period. So even if your plan has a 1-month wait period, not for this rehired person, they're in immediately. Now, if that person did not have any vested money in the plan and was not eligible for the plan when they were previously employed, they will hold on to the prior service that they earned if they have less than 5 breaks in service when they're rehired. Otherwise, if it's more than that, then they will be treated as a brand new employee and have to re-earn that service. If they, when they were previously employed, met the plan eligibility requirements but did not get to a plan entry date, then they would be immediately allowed to participate in the plan as well upon rehire. Rehire situations can be a little bit tricky because everyone's just a little bit different. So if you are ever not sure, again, reach out to your Nova account manager. We're always glad to go through the situation with you to make sure that it's handled correctly. I want to talk about the long-term part-time employee requirements. These were mandated with the Secure Act and were effective at the beginning of 2024. And these rules apply for plans that do have that 1 year of service requirement, that wait, and the 1,000-hour requirement before an individual can get in. If your plan has something less than that, like maybe your plan allows all employees to join the plan after 3 months of employment or after 6 months of employment, the long-term part-time employee rules won't apply to you because you're not looking at hours to determine if an individual can get into the plan. But for plans that do have that 1,000-hour requirement, these rules do apply. And if you have an employee who has 2 consecutive years of working between 500 and 999 hours, they must be allowed into the plan to at least make employee deferral contributions. Employer contributions are not required under the long-term part-time employee rules, but they do need to be allowed to make employee contributions. Now, non-discrimination testing is something that the IRS requires, and there's different types of tests, and that includes coverage testing, profit sharing testing, and compensation testing. And we'll take a look at some of these. The ADP test compares the amount of deferrals that highly compensated employees make to the amount of deferrals that non-highly compensated employees make. And failures are usually corrected by issuing refunds to the highly compensated employees. So who's a highly compensated employee? Well, for 2026, anyone who earns more than $160,000 in 2025 will be considered a highly compensated employee in 2026. Also, anyone who owns more than 5% of the company is considered a highly compensated employee, even if their compensation is under $160,000. And anyone who is a lineal family member or spouse of that 5%, more than 5% owner is also considered an owner by attribution, again, regardless of the amount of compensation that they earn. So if you have a child who works for you and they're making pretty minimal amount of compensation, they would still be considered a highly compensated employee for your plan. Top-heavy testing uses key employees. They use a different category of employees. They call them key employees, and it looks to make sure that key employees don't have more than 60% of the total balances in the plan. And if your plan has more than 60% of its balances owned by the key employees, then your plan is considered top heavy, and there are additional contribution requirements that need to be made for non-key employees. So a key employee is, again, anyone who is greater than a 5% owner, and that also includes anyone that's related to that 5% owner that works for the company. But a little bit different from highly compensated employees, it looks at 1% owners with compensation that's greater than $150,000 would be considered a key employee, or any officers of the company with compensation greater than $230,000 be a key employee. So looking at those tests, you might be saying, well, how is my plan going to pass all those tests, and is this plan still going to be beneficial to me as a highly compensated employee? The IRS does have a solution for that, and that is called a safe harbor plan. And safe harbor plans are exempt from ADP ACP testing and also top-heavy test. So if your plan is set up to be a safe harbor plan, it's going to have one of these types of contributions that go along with it. It's either going to have a matching contribution, and this is a required match. You can't change your mind and still keep your plan safe harbor status. The match is required, and the basic formula is 100% match on the first 3% deferred by employees, and then a 50% match on the next 2. And there are variations that can be done, but that's the basic formula for the match. Or you can choose to do a non-elective contribution, and that's not a match. It's given to all employees regardless of whether or not they choose to make employee deferral contributions, and that is a 3% contribution to all employees. And these contributions need to be 100% vested in order to keep the plan safe harbor status. Now, there is another option that goes along with the automatic enrollment feature, and it is called a qualified automatic contribution arrangement, or a QACA safe harbor formula. And plans must use automatic enrollment feature for this, and all new plans now are required to use automatic enrollment, so we are seeing more new plans use this QACA formula. And that is either the 3% non-elective contribution to all eligible employees, or a tiered match, which is 100% match on the first 1% deferred, and then a 50% match on the next 6% of compensation deferred. And the nice thing about the QACA is it does actually allow you to have a vesting schedule, and that is a 2-year of service vesting schedule. And now we're going to move on to moving pieces, and I'm going to trade it off to Charlene to wrap us up with the second half of our webinar.
Okay, Charlene, I went ahead and made you a presenter.
And Charlene, I just want to remind you that you are muted. So when you're ready, make sure you take yourself off.
Got it. Thank you so much. All right, can you see that, everyone?
Yes, we can see it.
Perfect. All right, well, thank you so much, Christine. Now we're going to go through a couple of different topics. The first is going to be some moving pieces. So, how does money get to the plan? How does money get out of the plan? If you have a record keeper that has a secure website, which most do, then you're going to be uploading a contribution file for each submission that you have. So after each pay period, you'll be uploading a file to the record keeper that contains such information as the employee name, the employee social security number, and the contributions that you're uploading. If you have the service that Christine was talking about with the integration of the 360 integration, then you're going to be providing this data for all employees, even if they don't contribute. But if you don't have the integration, you're only going to be providing that information for those people that defer. So just make sure with the record keeper, which is the person who holds the money or the company that holds the money, make sure that you check with them on what kind of file that you're providing. Once you provide that file to the record keeper is going to track that by money source. So for instance, if you're uploading a file of pre-tax deferrals, Roth deferrals, and a safe harbor contribution, those 3 items will be in separate columns on that spreadsheet. And then the record keeper will track that money by source and accumulate those for the statements. Who calculates the employer matching contribution? Unless there's a special engagement with you, Nova is going to calculate those if they're on an annual basis. But otherwise, if it's a payroll by payroll match calculation, so the participant would receive a match on the deferrals for each pay period, then you would go ahead and calculate that on your own and upload that with the employer and the employee deferrals that you're uploading. If you calculate that match on an annual basis, so you would only be making 1 deposit per year, typically Nova is going to be providing that calculation for you by person, and that will be completed when we complete the annual compliance testing. Who's responsible for preparing the 5,500? As Christine mentioned, the 5,500 is required each year, and it provides some informational type items for the Department of Labor. Unless there's a special engagement, Nova is going to be preparing that 5,500, and we'll go over the due dates for those 5,500s. And then once we provide the 5,500 draft, the plan sponsor, you guys, will review the 5,500 and electronically sign and submit. The 5500 has been required to be submitted online for a few years now. There's no longer the paper form. So you would need to have electronic signature details from the Department of Labor. You can sign up for those credentials and then use those credentials to submit the 5500. And your account manager can help you with that when you get to that point when you're filing the 5500. How does an employee get distribution paperwork upon termination of employment? Of course, a participant who's going to want to know where their money is and how they can get it when they terminate employment. We suggest that the first thing you do is provide a notification to participants when they get their other COBRA notices or other notices that you're preparing at the exit interview. This information will start a time clock for those force outs that Christine was talking about under $7,000. And it will also tell the employee how they can take their money from the plan, regardless of the account balance. Most record keepers will allow participants to request the forms online, or they may require that it be electronic, so no paper forms. So just check with your record keeper to see how that process has been set up for your plan, and then you can include that information in the notice to be given to employees. Again, if you have any distribution questions, just contact your NOVA account manager. They'll be able to help you with any questions that you need to provide to the record keeper, and then also help you with the process in general. Christine also discussed the notices, the summary plan description. That's not just the only notice that could be required for your plan, so we wanted to provide a listing here of those items. The first item is a summary plan description, which Christine mentioned. It's going to be the legal plan document summarized in a more layman's term booklet for the participant. So where the plan document or adoption agreement would house the legal provisions that you can choose, the summary plan description is just going to be in a different format, and that's the document that's provided to participants that gives them the provisions for the plan. Also required is the summary annual report, and this is the attachment from the 5500. So the 5500 is submitted and gives the Department of Labor information that's not participant specific, it's plan specific. And when that 5500 is filed, there's a 1 to 2 page summary of that 5500 filing that gets provided to participants. And that would be required each year after the 5500 is filed, and would be included in your 5500 filing as well for a download version. It does not get submitted to the Department of Labor, but it will be included in the web portal for you to be able to download a copy of that. Next would be the annual safe harbor notices. And again, Christine went over a couple of the safe harbor formulas. This is the annual safe harbor notice that accompanies the plans that have a safe harbor. So if you have a safe harbor provision in your plan, you would provide this annually no later than 12/1 of the year before it's applicable. So for instance, for 2026, that safe harbor notice would be provided to participants for 2026 by 12/1 of 2025. The next item for distribution is a special tax notice. The special tax notice describes to the participant the tax ramifications of the type of distribution they are taking. And it typically is included now, it didn't used to be, but it is typically now included as part of the distribution form from the record keeper, but it can be a separate attachment. So just make sure when you're providing distribution details to a participant that it includes the special tax notice. Next item is the annual 404A5 fee disclosure notice. And what this is a notice to participants of what the fees involved in the plan are. They would be distribution fees, loan fees, but then also for the actual fees that are provided from the funds in the plan. So if the funds have a fee attached to it, which more than likely they will, but that is enclosed in this fee disclosure notice as well. Sometimes the record keeper will distribute this notice for you, but again, I would get with your record keeper to make sure what notices they're distributing. They could also be distributing the Qualified Default Investment Alternative Notice, or the QDIA notice. This is a notice to participants that if they do not make a fund election, but they are having deposits of money made from the plan, whether it's possibly their own deferrals, but typically when they have a deferral election, they would have already selected their funds that they want them deposited in. But for instance, say that you're making a profit sharing contribution, but the participant does not make their own deposits, they don't defer their own contributions, they may not have an account set up with a record keeper yet. And in that circumstance, if they don't make a fund election by the time that profit sharing is deposited, then the Qualified Default Investment Alternative Fund will be the fund that they're deposited in. And typically, actually almost always now, that QDIA is going to be the target date or lifestyle funds. Lastly is annual automatic enrollment notices. So if your plan has an automatic enrollment plan, or what we call an opt-out plan, participants would need to get a notice each year that you have an automatic enrollment notice, and that if they do not make an election, they would be default enrolled, or not default enrolled, automatically enrolled into the plan at whatever percentage you have selected for the plan. This just helps people actually save for retirement and prevent participants from, not wanting to hassle with filling out the paperwork to opt into the plan. If they don't fill it out, they will be automatically enrolled and can start saving for retirement. So as you can see, there's quite a few distribution notices here. So we would just, again, ask you to see who's responsible for sending those notices and make sure that they're provided each year to the participant. We do have a sister company that does prepare or handle the distribution of the notices for you. If that's something that you're interested in, rather than having yourself distribute those notices, then just reach out to our AFS team at proposal@afs316.com, and they can help you with what the cost would be for that mailing. Then what they will do is they will reach out to you each year when there's notices to be distributed. They will provide you with a sample of what that notification will look like, so that you can review it and approve it before it's sent out to your participants. So if that's something you want to sign up for, happy to have you join on to the AFS team. So next we're going to talk about money again leaving the plan and how these distributions impact you or your participants. There are some that are going to be discretionary, you don't have to have in the plan, and we'll go over those as well. So once money goes into the 401k plan, it becomes subject to the rules and regulations of when money can leave the plan. We will sometimes have participants, it's my money, I should be able to take it when I would like, but the money is meant to be retirement. So the money, once it goes into the plan, again, has certain restrictions as to when you can have it leave the plan. And if a participant meets one of those requirements, then they can take a distribution of their funds. Otherwise, the money would stay in their plan until they have a due date, a distributable event, and can keep that money into the plan. So some reasons that we might have for money being distributed from a 401k plan, obviously the first one is termination of employment or retirement. If a person leaves your employment, they can certainly take their money with them, and we would actually encourage them to take the money with them, because that would prevent you from having to distribute notices to them on an ongoing basis, or the participant becoming lost at some point. They may change their name, they may get married, have a different last name, they may change their address, and you lose track of them. In order to prevent that from happening and having to distribute certain notices to them, they're certainly encouraged to take their money with them so that you don't have to track them on an ongoing basis. The next reason is age 59 and a half, which is often called in-service withdrawal, and we'll go over those regulations. a hardship withdrawal, or unfortunately, if they die or become disabled. So there's several reasons that they can take money out of the plan. If a person terminates employment or retires, the withdrawal forms can be submitted prior to their termination date, but the funds will not be distributed until their last day worked. So the distribution form will often have what the last contribution being submitted for the client or for the participant is, and what their last day worked is, so that that distribution cannot occur until after those dates. Most record keepers, again, will not distribute the funds until after the payroll contribution is received. But let's say that you have entered onto the form that this participant, their last deposit will be 10/15/2025. But then later you find, oh, we have an additional deposit we may need to make for a match true up, or you decided to make a profit sharing and they are eligible for that year's profit sharing. You can certainly deposit that amount into the participant's account, which you're required to do, and the participant will receive a second distribution. So it's not that money can't go in after that final payroll contribution. It's just a marker to say if there's a floating payroll contribution between the date of the termination and the next payroll date, to avoid having two distributions, the record keeper will wait until after that last one has been deposited. But again, certainly you can still make contributions, just trying to prevent two checks for a participant who has just one payroll check outstanding. And then, of course, with a termination of employment, provide that special tax notice to the participant. Next is age 59.5 or an in-service withdrawal. So what this provision does is it allows a participant to take a full withdrawal or a partial withdrawal after the age of 59.5, even though they're still actively employed. So an employee can, and this is typically put in place because participants are readying for retirement. And as they're readying for retirement, they may want to take their funds and move it to their own financial advisor, or maybe take it to pay off some bills before they retire. Whatever the reason, there doesn't have to be a specific reason given, but for whatever reason, they can take that distribution after age 59.5, and they can still contribute to the plan. So just because they take a withdrawal at 59.5 doesn't mean they can't make more contributions and then get a second distribution. But again, this just allows participants to prepare for retirement in whatever preparations they need to do. And this is an optional item to have in the plan document. It's a nicety to have in the document because, again, people are readying for retirement, but you're not required to have it. The next distribution we'll talk about is hardship distributions. And again, this is a discretionary ability to have in the plan document. But what this does is it allows participants, for very specific reasons, to access their 401k account in case they have an emergency. And some of these really aren't emergencies that we would look at as called an emergency, but there's a specific reason that they need money from the plan. And again, this would just allow them to alleviate that hardship in case they need money out of the plan and have no other alternatives but to take money out of the retirement plan. There's still going to be a 10% early withdrawal tax that is assessed to the participant, but at least they are able to access money if they need it. There have been recent regulations on the Secure 2.0 Act that allows participants to self-certify their eligibility for hardship. If you have self-certification in the plan or want to add self-certification in the plan, there would be a certification that a participant reads and signs off on that says, I meet one of these criteria, and they would be listed out. They don't have to list out which criteria they meet, but that they meet one of those criteria, and that they are signing and certifying that they do meet that requirement. If you do not have self-certify in the plan, then the participant would be required to support to provide support documentation as to why they meet a hardship criteria. Sometimes participants will be less, they won't want to take a hardship distribution, if they have to provide documentation to the employer as a plan sponsor. The employee may feel embarrassed that they need this money, or think that there's some way that they may be treated differently because they're taking out this money. So self-certified does help in that aspect of not having to obtain that documentation for the participant. Here's the listing of allowable reasons. Purchase of a principal residence. So if a person has, just say they have a down payment of $20,000 that's required, they can provide supporting documentation and take that out of the plan as a hardship withdrawal. Prevent eviction from a home, unreimbursed medical expenses, post-secondary education, casualty losses, or burial expenses. So again, a very specific list of reasons that a participant can take a hardship, but that will help them in the long run for whatever reason they need to take it out. So just some options to have in the plan, but again, not required. Also in the plan is going to be death benefits. Obviously, if a person has passed away, their beneficiary is going to need access to that money and take that money. But we would strongly encourage, if your participants do not have elections on file, that they make beneficiary elections, so that in the unfortunate circumstance of them passing away, the money can go to the person they would like it to go to, or persons. If a participant does not have an election on file and they are married, that money will automatically go to their spouse. And again, unless there's another beneficiary on file. Our plan documents will dictate how that money is distributed in case there's not a beneficiary on file. So if you have any questions on that, just reach out to your account manager and they can let you know what those rules are. Another item that under distributions for money coming out of the plan is called a required minimum distribution. A required minimum distribution is a distribution for a participant that has terminated employment, or any owner that has turned age 73. So any terminated employee that's turned age 73, or any owner or family member who has turned 73, regardless if they've terminated employment or not, those individuals will be required to take a required minimum distribution each year. And that amount is determined based on what we call a life expectancy table that is included in the IRS regulations. And we will provide the dollar amount that participants need to take each year if they meet one of these criteria. Qualified domestic relations order, or what we call a quadro, usually comes up in the context of a divorce, but it can be for other reasons. But in this case, if you receive a domestic relations order, please provide it to your account manager at NOVA. Our team will review the domestic relations order and make sure that it includes all of the items that are required by law before we act on the instructions of that domestic relations order. The rules can be very complicated, so please contact the account manager with any questions on those and make sure that we get involved in getting those processed correctly. Spousal consent. So with most retirement plans, spousal consent is not required for a distribution or for a loan that we're going to talk about loans in just a second. If the 401k plan does require spousal consent, it's very important to have it. We want to make sure the plan is compliant. And usually the distribution is going to be less than $5,000 and include purchase money when a spousal consent is required. There can be other reasons, or maybe you've designated in the plan that you want spousal consent, but there's really no beneficial reason for you to add that requirement unless you have certain monies that require it. So if not under a certain reason that you need to have it in the plan, they will not include spousal consent in the retirement plan. So a participant can take a distribution whenever they would like without spousal consent, as long as they meet the requirements, obviously. So for loans is also an optional item to have in the plan, but again, it allows a participant some flexibility if they need access to money in the plan, but this gives them the ability to pay that money back. So they're not taking it for a long period of time, unless it's for a residential loan that we'll talk about, but they're not planning on keeping the money out of the plan forever. They're wanting to repay that money back to the plan, and they would actually be charged an interest rate, but that interest rate goes back to themselves as well. So they're borrowing the money from the plan without having to pay tax on this distribution, but they're repaying it back to the plan via payroll deduction. Some rules for loans, which can be, some of them can be customized to what your plan you want in the plan, but typically participants may borrow the lesser of 50% of their retirement account balance, but never any more than $50,000. And then most plans provide a minimum loan of $1,000. So a participant must have a vested balance of at least $2,000 in order to take 50% of that money for the minimum $1,000 loan. This minimum just puts in place a safeguard, or not really safeguard, but a limitation so that participants aren't using this as a savings account and just taking out money all the time. This would be a minimum amount that they need to take out so that they can get that loan proceed. Loans, again, need to be a reasonable interest rate. Typically, that's 2% over prime, so something that they would reasonably get in the market. Loans typically need to be repaid within 5 years unless it's for a residential mortgage loan. And loans, again, are paid through payroll deduction. We have generally on this slide, because you can make a provision in the plan that you allow checks to be paid as well as payroll deduction. We do not advise on that because it limits the way that you can oversee the plan. If you have participants sending you checks or sending the record keeper checks, you can't make sure that they're made on a timely basis and make sure your plan is in compliance. So we would always advise that this only be made through payroll deduction. Also, if a participant terminates employment, they no longer have compensation coming in from the company, then loans will become due upon termination of employment. They can repay the loan in full, but it will be due upon termination of employment. There are fees assessed for loans. There is an origination fee, and there could be record keeper fees as well. Moving on from distributions, we do have a lot of limits that have changed in recent months. There are several different catch-up limits that are offered now. If your participant is under the age of 50, the limit for deferrals for 2026 is $24,500. If the participant is 50 to 59 or 64 and older, so the second bullet point and the last bullet point here, their limit with catch-ups is going to be $32,500. But if a participant has this in-between age that regulations added of 60 to 63, there's going to be an additional catch-up for those participants, and their limit's going to be $35,750. So work with your your payroll company to make sure you have each of these categories of deferral limits that include these catch-ups. As well, there's a limit on how much a participant can receive as total contributions, and that would be contributions of match, deferral, Roth, profit sharing, any contributions that they're receiving. Here's the limits for those as well. There's more limits here. The compensation limit that Christine mentioned for 2025 is $350,000. It's going to be $360,000 for 2026. So again, some of the limits that you'll see here for your reference. The next item we wanted to stop on is information for Roth catch-ups for highly paid individuals. And this is a regulation that the administration of is going to start in 2026. And what this is a special provision for employees who meet a certain criteria that their catch-up contributions can only be made as a Roth contribution and not as pre-tax. And so this only applies to those individuals that are a highly paid individual, an HPI, and those are employees who have made more than $150,000 in 2025 in FICA wages, so box 3 of the W-2. And they're at least 50 years old starting in 2026. So if a participant meets both of those criteria, they will only be able to make catch-up contributions in the form of Roth contributions. So very important to make this note and get this set up with your payroll company. And then also we have a webcast that we've given in the past, I guess, 2 weeks. Here's our link to our YouTube channel that we have all of our webcasts listed, but it will have these Roth catch-up webcasts that has a lot of detail on what's expected and how to get this set up. Okay, with the next few minutes, I'm going to go through an annual calendar. Before I do that, I just want to back up a couple of slides, and we're going to go through this in the annual calendar. But when I talked about the Form 5500, I just want to talk about the due dates of the 5500. So for the 5500, the first due date is always July 31st of each year. So whether you're a large filer or a small filer, and just a reminder that large filer versus a small filer is a plan that has more or less than 100 account balances in the plan. If you have more than 100 account balances, you'll be required to submit also an audit report with the 5500. And so if you're in that situation, just make sure that you have an auditor engaged so that they can complete that annual audit that will be submitted with the 5500. But the first due date for that, whether you have an audited plan or not, you will have by July 31st to file that 5500. If you cannot get it done by July 31st, the 5500, and more than likely with an audit, typically the audited plans will take more time to finish all the work on and get that audit completed. And so there is an extended due date of October 15th each year. So an extension can be filed with the Department of Labor, and then you would have through 10/15/2000, well, in this case, 10/15/2026 for the next due date to get that completed. Under no circumstance is a due date more than 10/15 of each year. But there would be penalties that are assessed if it's after 10/15. So it's really important to make sure that you have kind of all your ducks in a row for completing the 5500, and if you're required, an audit as well, so that you can get those done by one of those due dates without any additional penalties. If we go back, and we included this information on the annual calendar. So if we go back to the annual calendar, we'll look at this time frame of January through March. And some of these are going to be duplicated, so we won't go over every one of them. But 1099s are going to be distributed by the record keeper no later than January 31st, so coinciding with your W-2 due date. And this is for any employees that's taken a distribution from the plan. They'll receive a 1099 of whether or not that distribution is taxable and can be filed with their tax return. If you have a calendar year plan, we're going to ask that the first census data be submitted to us in January of that year. So each year you'll be required to provide census data to us So for 2026, you'll be submitting data for 2025, and then we'll complete your annual compliance testing that Christine went over earlier. Once that census data has been received, we can complete that, but we would hope that you can provide it in January of each year. But if you can't, then you'll see that this is an ongoing theme on each of these months to submit your data to us if you can't by the end of January. Participants should receive their fourth quarter and annual statement from the record keeper. So they will receive quarterly statements, and the first for the prior year will be in January. This is going to be an entry date for plans that have semi-annual, quarterly, and monthly entry dates. So make sure you're aware of your entry dates into the plan once a participant reaches their eligibility requirements. If your plan has monthly entry dates, January is where you should be submitting giving your participants their enrollment materials by January 1st for February 1st. This gives them a month to be able to make their elections and then get that set up through payroll. So you'll see here we have the year-end census data. We're moving into February. NOVA is going to be working on annual compliance testing as we're receiving those census data. Again, entry date for monthly entry. And if you have monthly entry, provide enrollment materials. So again, some of these I'm going to skip over because they are dependent on what your plan has. But the first one I'm going to bring up here that is not is any plans that are not safe harbor. So you're subject to average deferral percentage or average contribution percentage testing. Those refunds will need to be made to participants no later than March 15th if your plan does not pass, and without penalty. So if the earlier you get us your data, the earlier we can complete that testing to make sure that if you have any refunds that are necessary, that they will be completed by March 15th. So really important date there to note. Moving into the next April through June time period, one thing or a couple of things I want to highlight. April 1st is going to be the first due date for people who are due required minimum distributions. That is their first distribution. So this is the first distribution required after they've met age 73. Typically you have by December 31st each year, but for that first requirement for participants who are just starting their RMDs that have reached 73, you have a little bit of a grace period through April 1st. So if they were required to take a distribution at age 73, their first date will be April 1st, and then December 31st every year thereafter. Excess 402G refunds. So this is for participants who have gone over for 2025 $23,500 and are not catch-up eligible, or they went over the full amount of, let's see, $31,000 if they were having catch-ups. If they went over one of those limits, they're over what's called the 402G limit, and they will be due a refund by April 15th without penalty. If after April 15th they will get a penalty, it's pretty stiff penalty. So we do ask that the participants get that data to us so we can have those processed. This may be something that's out of your control though, because these may be participants who moved from one employer to another, and they don't realize they went over that limit when adding their W-2s until they're finishing their tax return. But what you can control is anyone that your payroll system has had employees reach that limit and gone over that limit. So make sure that you review your payroll reports when you're doing your your W-2s to make sure if anyone's gone over that limit, we get those corrected. Again, we talked about the 5,500. So for plans that we've received the data and finished the compliance testing, we're going to start working on those 5,500s for those plans starting in May. We're going to continue that work until the due date of July 31st. We'll have the due date here. Again, a lot of these dependent on your plans. The summary annual report I talked about earlier, which is the summary of the 5,500 data. The due date to get that to participants is going to be in July. If you've filed the 5,500 by July 31st. So another item to be aware of. Let's see, again, the extended due date of the 5,500 is going to be October 15th. And here's your notice requirement. So we talked about all of the notices that are required for your plan. These 3 must be distributed by December 1st before the applicable year. So for 2026, these 3 notices need to be distributed by December 1st. Let's see. Again, here's your required minimum distributions. They're going to be required by December 31st each year, except for that original first RMD for a participant. All right, I think that's it, except we wanted to provide our webinar schedule for 2026 is going to be out, and you can go ahead and visit our website here and start signing up for those webinars. I think Ava's going to go over the remainder of this portion, but thank you for everyone joining us, and I'll let you take it over, Ava. And you're on mute or something. We can't hear you. Nope. Can't hear you. Do you want me to go over this last slide? Nope. Well, I don't think we're going to be able to get Ava back. So let's just reminder, if you do need CPA credit, you'll receive an evaluation survey. Make sure that that's completed, and then you'll receive a certification with it via email within a week of that certificate. And I think that's all except for our contact information here. If you have any questions, reach out to us, but otherwise you can reach out to your account manager here at Nova. And we, again, appreciate you joining us, and we look forward to working with you guys. Thanks so much and have a great day.